information, new claims data, that those plans issued in 2000 will have a rate, or have the potential for rate increases of around 40%. Policies issued in 2007, they tried to adjust those assumptions a little bit. So the lapse rate they assumed was 1.1%, interest rates 5.9% again for the life of the policy, and there is still a 30% chance that those policies could experience some sort of rate increase. Today, or in 2014, they adjusted them even more. Lapse rate now at 0.7%, so less than 1%, 4.6% interest rate, and then also they still have a 10% chance of having a rate increase. And so a lot of those issues, the pricing assumptions, the rate increases, the whole conversation of if you don't use this product, you'll lose it, no guarantees, has really what's led to the linked benefit hybrid products to kind of take over, because they can either offer level premiums or no rate increases, and you get your money back one way or another, live, die, or quit. And so I don't want to discount individual long-term care plans whatsoever, because they are still the most robust benefit offering of any of the alternatives out there today. And so they're definitely a great opportunity or a great product for those that can afford it. Just sometimes they can become cost prohibitive. So in 2010, 13% of the population was over 65. By 2030, that percentage is supposed to increase to 20%. And so every single day, there's 10,000 people turning 65. So if you think about it, today, tomorrow, and the next, that's 30,000 people that are now 65. And 70% of people over that age of 65 can expect to use some form of long-term care during their lives, well, whether it's skilled nursing care, informal care, one way, shape, or form, it's likely to happen. Today, more than 2/3 of healthcare costs are for treating chronic illnesses, and among healthcare costs for older Americans, 95% are attributed to chronic diseases. And so the cost of providing care for those people over 65 is 3 to 5 times more expensive than for those under 65. By 2030, they're expecting healthcare to increase by 25%, largely again because that population will be older, and that estimate doesn't take into account inflation or higher costs of new technologies. And so, basically, again, all this information, all these statistics are leading to a greater and greater need for people to have individual insurance or individual solutions. So as you're all aware, how do we define chronic illness? To be considered chronically ill, a licensed healthcare practitioner must certify within the preceding 12-month period that the insured is 1, unable to perform without substantial assistance from another person at least 2 of the 6 activities of daily living due to a loss of functional capacity for a period of at least 90 days, or 2, requires substantial supervision to protect the insured from threats to health and safety due to that severe cognitive impairment. And so some of the major chronic diseases of the elderly that we're all familiar with, heart disease and cancer, actually count for almost 50% of the top causes of death. COPD, disease of the lungs, cerebral vascular disease, restriction of blood flow to the brain, like strokes. Alzheimer's is obviously a very, very big one. Diabetes, arthritis, not always one that's considered when thinking about long-term care, but really it's limiting your ability to perform those 2 out of 6 activities of daily living. Influenza, pneumonia, kidney disease, and blood infection, but 6 of the top 10 diseases for those 65 plus were from chronic illnesses. Again, so basically they are very, very prevalent and very, very deadly. Alzheimer's is actually the 6th leading cause of death in America. 1 in 3 seniors will die from the disease, and every 66 seconds, someone is diagnosed. So here's a quick look at our long-term care chronic illness portfolio. We do have our long-term care agreement still available in California. We are transitioning to the accelerated death benefit for chronic illness agreement. And so the only state that is not available is California. We have our chronic illness conversion agreement, which I thought I'd change this, is actually available in New York as well. So only California, Hawaii, Mass, and Washington are not available. And Washington is not likely to approve it as they completely rejected our filing. So don't look for that there, but that's a great opportunity to get the conversation rolling with younger individuals that maybe only have the funds available for a term product. As you know, we have our Care Shield product, which is only not available in California and New York, our chronic illness access agreement, which is the original discount no cost to carry product, available on Orion. So that will have both the chronic illness access and the accelerated death benefit for chronic illness agreement in that Orion product. And then today we're going to be focusing on SecureCare, our new Universal Life 7702B product. So to give you a background on SecureCare's long-term care journey, we actually had our own standalone long-term care product back in 2005, 2006, called LTC Guard. At the time, we didn't feel we had the right distribution in place to make it a profitable block of business, and so we decided to exit that market in 2009. All the while, we were researching into our first either long-term care or chronic illness agreement. As you can see, we felt the long-term care agreement better fit our value proposition of doing what's in the best interest of our clients. And so we were able to offer with the long-term care agreement a product that did not have the permanency requirement. We could charge for it, we could underwrite for it, giving the client a dollar per dollar reduction in their benefits. And so we had that product going along for about 6 years. And as there were changes made or different plan designs that were starting to be accepted by the compact, we made the decision to switch over to a chronic illness agreement on the 101G. So they essentially got rid of the requirements for permanency. We could underwrite for it, we could charge for that product, and essentially give the exact same benefits to the client that we had in our long-term care agreement, with the added benefits of we could market it a lot easier. There weren't the filing restrictions. From an agent's perspective, it didn't require all of the continuing educations and licensing. And then from the client's perspective, it took it from a traditional indemnity benefit to a cash indemnity benefit. So making it just a bit easier for them to access their benefits. And so you can see we've made a massive investment in our overall long-term care chronic illness portfolio, and we've launched the chronic illness agreement, the chronic illness conversion agreement last year in August. We launched CareShield in September, and then we just launched chronic illness access agreement in February and SecureCare in March. And so this is just the beginning, and we have a major focus in the long-term care space. And so look for more enhancements, more products in the future. But today we're just going to focus on SecureCare. And I did talk about this already, but if you're not already, in order to sell our long-term care agreement, you must first complete the state required training. And we do have an agreement through ClearCert. So if you have any additional training that you need, feel free to go through there. I'm assuming most people are good to go on that. So without any further ado, let's get into the meat of the presentation. This is SecureCare, our new guaranteed single premium universal life contract with embedded benefits for long-term care. So as you can see in that little graphic, we have 3 guaranteed buckets. We've got guaranteed long-term care pool, we've got a guaranteed death benefit, and a guaranteed return of premium. And our guaranteed interest rate is actually the same as our current interest rate, so 4%. So everything that you'll see if you do start quoting or on our proposals, that those are all going to be guaranteed numbers. And so kind of a fun story to tell, especially when you get a significant leverage on top of your premiums. From a design standpoint, we offer face amounts from $50,000 up to $750,000. That will depend on the different acceleration durations that you choose. But we have issue ages from 40 to 75. Due to the single premium nature of this first iteration, we're assuming that it's going to be closer to the 55 to 65, probably in the low to mid 60s. So people nearing retirement or just recently retired will probably be the most active users of these. We will be coming out with some enhancements later this year, as well as a multi-pay version in 2018. And so keep your eyes peeled for that. But today, based on some administrative restrictions or limitations, we had 3 product launches in the last quarter. And so we decided to start with our single pay version first, as that was still the majority of premiums being offered or paid in the marketplace. But as with the majority of standalone long-term care and even linked benefit products being reimbursement style plans, we are very happy, very excited to offer only one of 2. The only other carrier to offer an indemnity plan is Nationwide, And so again, fitting our value proposition of making it easy for the clients to get access to their benefits, we're very, very happy to have a traditional indemnity plan. We do have a 90-day elimination period, as again, Medicare will cover, usually the first 100 days of the stay, with a couple caveats, and I'll get into that. But we do have a minimum long-term care death benefit. So if the client uses their entire policy, they exhaust all benefits, there is still a minimum death benefit of 10% of the face amount up to a maximum of $10,000. So if they had a $50,000 face, for example, their minimum LTC death benefit would be $5,000. On the right-hand side, you can see our return of premium vesting schedule. This is pretty marketplace standard, but year one, if they wanted to get their money back, they could get up to 80% back. At the end of the 5th year and every year thereafter comes with a 100% return of premium. And so you'll see this similar schedule with Lincoln if you're familiar with their product. So the three main features that come with all linked benefit products is that there is an acceleration period, which is on the base face amount. Then there are only 2 optional agreements, making it very, very simple to talk about. We have our extension of long-term care benefits agreement and then our inflation agreement on the next slide. But essentially, you can create a pool of benefits for 2 to 7 years in some combination with the acceleration and extension of benefits. So depending on how long your client would like to receive, they can choose up to 7. They can also choose, with one caveat, I'll get that on the next slide, less than their monthly maximum benefit, which would extend the life of their benefits paid. So that's similar to any of our other products where, let's say they have their monthly maximum is $5,000. They could choose to take $2,500 if that's all they needed for expenses that particular month, and that would just extend the life of that benefit by another couple years. And so there is an acceleration for terminal illness on the base face only, and I believe that's the entire face amount up to $10,000 remaining. So if you had a $100,000 face, you could take $90,000 if they were considered terminally ill, given less than 12 months to live. And so same rules apply for the extension of long-term care benefits. You can take less than the monthly maximum, again, with the caveat of inflation, which I'll get to. But there is no extension or terminal illness benefit on the extension. It's not part of that base contract. So the second optional agreement is the inflation. We have a 3% simple, a 5% simple, and a 5% compound option. One of those enhancements that we're looking to make is having a 3% compound interest, similar to what Lincoln offers. Again, based on that single premium nature and the older age of the client, there are scenarios where it doesn't necessarily make sense to include inflation, just depending on when they feel that they may go on claim. So the older the client gets, the longer it would take to cross over that same benefit amount by adding some of these more expensive features. But the inflation options inflate both the acceleration and extension of benefit portions, and 100% of that monthly maximum benefit will be paid if they do choose inflation. So that was the caveat I was mentioning, where you're no longer able to take less than your monthly maximum benefit if you include inflation. And the reason for that is there are scenarios where the client had the policy long enough, they decided to skim off only the inflation, there could be a lifetime benefit achieved that way. And so if there's inflation, they will have to take the full monthly max, no questions asked. For our included benefits, we have a pretty wide range: adult daycare, assisted living, skilled nursing home, and all the way down to informal care. Really, the only things that I've seen in our contract is if there's a facility in a state that is not licensed, that is something that we would typically not approve. And so I don't know how many facilities out there are not licensed in the states that they are providing care. So I don't think it will come up often, but that again is part of that indemnity style benefit. We have the ability to pay benefits for almost everything out there. A couple keys that I will point out are benefits outside the United States. So we have a 50% monthly benefit if I go back to the $5,000 example. So we'll pay $2,500 out every single month if the client is living abroad. The difference between our product and the other carriers is that we actually have benefits outside of the United States on both the acceleration and the extension of long-term care benefits. The other companies like Lincoln, Pack, and Nationwide, they only have that available on their acceleration periods only. So in order to receive any benefits, the client would have to physically move back to the United States, which, if you're being realistic, someone who's going on care in Spain, for example, is probably not going to move back to the United States. So essentially negating any of the leverage that they had created with this type of product. Our caregiver training and home modification are two benefits that can be accessed before the 90-day elimination period has been satisfied. And so if the client needs or a spouse needs training on how to give an injection or some other procedure, we'll pay up to $1,000 before the 90-day elimination period has been satisfied. If they want to put in ramps, rails, or a new bathtub or something like that, we'll pay up to $5,000 for home modification. And now that is not in addition to their total benefit. That is just getting access to their benefits earlier. From our underwriting process, it is a streamlined underwriting and a simplified issue. So they're either in and they're out, and similar to our other long-term care or chronic illness benefits, the range of risk goes from our preferred select all the way down to a table D. And now it's a little bit different than some of our other products just because this product truly is more focused on the morbidity underwriting than anything. But essentially, you're in or you're out. We have paper or e-app accepted. The client will complete a truncated Part 1, as it is specific and unique to SecureCare. So be aware that if you're applying for multiple policies at the same time, there are two separate applications, and then there will two separate underwriting processes, as this, again, is unique. But they will complete a tele-interview and a cognitive assessment for those individuals at the age of 56 or older. Average length of time for a tele-interview is 30 to 40 minutes. Average length for a cognitive assessment, and that gets more and more robust as the client's age increases, somewhere between 10 and 20 minutes. We're doing a prescription check and MIB. We're only taking attending physician statements for cause, and there are no paramed or labs. And so from the completion of the tele-interview, if assuming there is no APS required, average turnaround time to a decision is 6 days. So if the client can get the application submitted in good order, gets the application or the tele-interview scheduled, it can be a very quick turnaround time from the initial app to coverage. And again, as I was saying, simplified issue, so you're in or you're out. We do have gender-specific rates, non-tobacco, and then a couples or a singles type of policy. So for the couples, there is a discount of about 5 to 10% depending, but only one person in that relationship needs to apply. So as long as they're in a marriage or a domestic partnership or something recognized by the states, they would qualify for that discount. Eligibility benefits is the same as our other products. Again, they need to be certified as chronically ill. They need to be receiving qualified long-term care services. And as I mentioned before, with our wide range of covered benefits, all the way down to informal care, that should be fairly easy to satisfy. We do have a care management staff that will work directly with the client to help provide or help develop, I should say, a plan of care specific to their needs. So if they determine that, yep, informal care is just fine, based on, let's say they had early onset Alzheimer's, usually first couple of years they can still live at home, but as that disease progresses, they may need to move into a memory care facility later stages. So, and then after the elimination period has been met, again after, or with the caveat of caregiver training and home modification, they'll start to receive their maximum monthly benefit. So from the competitive positioning standpoint, these are how Lincoln, PAC, and Nationwide and SecureCare has decided to position their products. They're not how we stack up against each other. I have a couple slides on that, but Lincoln, they wanted to offer the most initial death benefit for the least amount of premium. They put less emphasis in their inflation pricing, and they are a reimbursement model. PAC Life, their Premier Care product, they wanted to go the opposite direction. So they wanted to offer the richest inflation options and richest LTC pools, but the least amount of death benefit, and they are as well a reimbursement plan. So Nationwide, Your Care Matters, they are the only other indemnity style benefit out there, and they're pretty competitive across the board. But from SecureCare standpoint, we're obviously leading with our indemnity payments. We wanted to provide the most initial death benefit for the least amount of premium. And then again, the inflation options based on the single premium of this first type of product we put less emphasis, and we're actually still pretty competitive across the board on inflation. PAC will take some of the cells once you get into the higher inflation amounts, but to give an example, so as the inflation options vary across the board, so Lincoln offers a 3% and 5% compound. We have the 3% simple, 5% simple, 5% compound. PAC's the exact same. And then Nationwide is 3% simple and 5% compound. It's tough to get benchmarking, as you can see. They're pretty varied across the board when adding inflation. So I ran a couple, or I'm showing a couple examples, and this is not taking into account the new rate increases that Lincoln just sent out, I think, the other day. Haven't had time to update it, but essentially, this is a 60-year-old female. They are couples discount non-tobacco. They're putting in a $100,000 lump sum premium, and they decided to do a 6-year benefit duration. So their acceleration of 2 years gives them a face amount, a guaranteed face amount of $167.24. Adding the 4-year extension, equaling a total long-term care pool of $501,072. And so they just created 5 times leverage on that $100,000 lump sum premium, which for the most part, these products are sold with idle assets that are allocated for the need of long-term care. They're sitting in a low interest rate account, a cash account, money market, CDs, for that unexpected healthcare issue. And so by saying, hey, we could move this over, we have guaranteed death benefit, guaranteed long-term care, and guaranteed return of premium, what's there to lose? But I'm not going to read everyone else's numbers. As you can see, we're very, very competitively priced in this space. Just for a second comparison, this is just a 6-year-old male this time. So again, the same parameters, 6-year total benefit duration, the 2-year acceleration is their guaranteed death benefit, the extension of benefits, and then a total long-term care pool, $480,530. And so again, we're very excited about how we're looking in this space. And part of it is because we have a pretty good risk tolerance for these products. We don't have, like Lincoln does, these massive blocks of business that have been on the books in these high interest rate environments. And now that we're living in a low, we feel very confident that we're well positioned for the future. So the main marketing messages that we are going with is that we have our 3 guaranteed ways that you or your beneficiaries can get your money back if you need long-term care at death. Even if you've exhausted all of your long-term care benefits, there will be that minimum long-term care death benefit. And at any point in time, especially after the 5th year, if they need to get their money back, they can access that through our return of premium option. So we want to offer ultimate choice and flexibility. How much premium do they want to pay? How long do they want benefits to last? Do they want to include inflation? What type of care do they want? Where do they want to receive it? That's one of the big issues facing seniors is I don't want to leave my house if they don't have to. And so with SecureCare being indemnity again, they can choose that where do they want to receive care and what type do they want to receive. From our portfolio positioning, this is just how I tried to wrap my head around some of our products where we have assets required and then product complexity. So I think of SecureCare as being in this lower left corner. It has limited complexity as there's only one optional agreement on there. And then depending on the amount of death benefit the client wants, it could require higher or lower assets. Our life products with chronic illness agreement cover a pretty wide range depending on if they skinny down one of our VUL Defender, Eclipse Protector, or do a large lump sum premium into our premium deposit account, which I think Dave mentioned again, or mentioned to me, the rates just went up. So if you haven't seen that, take a look there. But then SecureCare being on the top right, I take back, well, I shouldn't say I take back. From product complexity, I put it up there. Again, there's only 2 optional agreements, but it's just a different style product than what Securian has been used to in the past. And so, just helping our distribution get their heads wrapped around where it plays as it is a true long-term care focused sale. And so that's just kind of how everything falls together. As you can see, there's overlap across the board. And then as we make some enhancements to SecureCare, it's going to bring that bubble down a little bit in terms of assets required as we'll do an annual premium versus a single premium lump sum. Last thing, in terms of replacements, currently the replacement of standalone long-term care policies and life insurance policies with long-term care benefits are not allowed. We are currently looking into the filing and reporting requirements to determine if we allow replacements in the future. So if you have clients that have old standalone long-term care or even linked benefit products currently, like we're saying, or even products with riders and agreements, we are not able to replace those today. We are rapidly moving towards that availability, but for our original long-term care agreement, we just didn't have the block of business required to incentivize us to start allowing replacements. And so as we feel SecureCare is going to be a large portion of our business here in the next couple of years, we wanted to potentially open that up. And so again, we're looking into it, not available yet today, but if there's any questions on that, we can talk offline. And so that's all I have for y'all today. I know we wanted to open it up to some questions, and so do that.
Yeah, thanks, Kyle. We really do appreciate it. And to keep in mind, everybody, that we rolled out CareShield starting this past fall. We've done a number of webinars on it. We feel there's a definite fit for that product alongside this newer SecureCare. You've got the continuous pay option there with CareShield if your client doesn't have the wherewithal to write a big check. But if they do and they want to do an asset reallocation in their portfolio, the SecureCare is there for that as well. So they're both very, very strong offerings from a very strong carrier. But yeah, I'm going to start unmuting people slowly here.
Mm-hmm.
And I can only unmute you if you put in your audio PIN number. And if you have me on a speakerphone, I would appreciate it if you took me off speakerphone. Again, I can only unmute you if you put in your audio PIN. And if I hear a lot of background noise, I'm going to mute you back off as well. Okay, the lines are open. So if anybody have any questions of Kyle about the SecureCare or even CareShield for that matter. Okay, if there are no questions, we sincerely appreciate you joining us today. We hope you have a better understanding of this new offering from Minnesota Life. We're pretty darn excited about it, but thanks everybody for joining us and make it a great day. Thanks, Kyle.
Thank you, Dave.